People are signed up. She said 20 when I asked her earlier this morning.
Yep. Same. We're live.
We're live. Well, hey, welcome everybody. Thanks for joining us. I'm Greg Reese. This is Paul Brar. We're with Reef Point LLC. We serve as fiduciary trustees, corporate trustees for a tax deferral strategy known as the Deferred Sales Trust. We're here to provide some information on a strategy that can help business brokers close more deals and by eliminating their capital gains worries. And so we're going to try to keep this to less than 30 minutes. We do have chat available, so if you have questions along the way, Paul's going to monitor that, and we'll try to answer any questions you have, but we'll give you some other information on how to connect with us if you have additional questions beyond that. So I'm going to go ahead and start the presentation, I think, right here. All right, sounds good. So looks good to me. Hopefully it looks good to all of you. So listen, just in preface, I just want to say that, in our business, we primarily work with end users who are facing a capital gains situation, as well as professionals who work with clients who are similarly facing a capital gains exposure. So that can include business brokers, M&A professionals, realtors, CPAs, tax attorneys, transaction attorneys. Those are a lot of the professionals that we work with on a regular basis. Probably 5 years ago, we made a business decision to really focus a lot of our time and energy on working with and helping business brokers and M&A professionals. And the subject today is really geared entirely to that particular segment. So if you're part of that professional group, terrific. If you're not, that's okay too. But we just want to share some information that we think can help you get more listings, get more referrals, not spend any more money in the process of doing it, and look like a hero and set yourself apart in your own industry. So those are some of the goals that we set forth when we do what we do, and hopefully you'll enjoy the content. So here we go, the secret to closing more deals. So by way of introduction, our tax is a problem for your clients and a nuisance for you. In our experience, the tax implication of representing a seller is a big hurdle. It's a big problem. And it's not something that, unless you have solutions to that problem, there's not much you can do about it. You just do your job and tell them to go to their CPA and figure out the rest, because taxes are a part of life. If that were the only answer that we could give, it is what it is. But if there's a solution to that problem, how can it help you? So what we're suggesting here is, how can you turn this particular problem or hurdle into an opportunity or an advantage for you? Because for everybody else, the tax impact and burden is a problem. So again, how do we turn that into an advantage or an opportunity? So one of the secrets here is how flipping the tax burden can turn into a sales opportunity for you involves, all of the above strategies or issues that we're looking at here. It can help you get more listings. It can help you expand your practice into higher dollar listings. And I know a lot of you folks are really looking, if you're a business broker, you're always looking to, how do I get into the next level of market on the higher dollar deals, even into the M&A side of the practice. How do you elevate your client service? That's all about setting yourself apart in your industry and in your marketplace to make you the go-to person that sellers are going to want to go to. How can we help you close more transactions? Because not every transaction you enter into closes, does it? At least that's what we're informed about. How can you earn more referrals? How can you help? This is the bottom line of our conversation. How do you help your sellers walk away with 25 to 35% greater net sales proceeds to help fund their future lifestyle? And of course, at the bottom, how can we help you collect a referral fee by partnering with us and helping your clients at the same time? All right. So let's get to brass tacks. Two most common issues, and I know there's a lot of commonalities in every transaction that you do. There's always certain obstacles or challenges that you have to face. And I know the timeline and the list of things that you have to deal with is pretty lengthy, but we're going to focus on two common issues in a typical transaction. The first one being that sellers oftentimes have unrealistic expectations about what their business is worth and how long it might take for their business to sell when they've actually made that decision. At some point in the timeline, and our experience and the feedback we get is sellers often don't even realize or recognize the tax burden or impact until somewhere down the line in the middle of the transaction, sometimes not till the end. And so once they do realize the tax impact, that can alter their behavior. It could either cause them to decide not to sell. It could force them to have to alter the goals that they have already concretely in mind about what they're going to do if they get their price and how that's going to impact their lifestyle. They have to make adjustments to what their expectations are. It could even imperil the sale itself, right? So these are changes in behavior and expectations that can occur once they realize what the tax burden is. And our experience has been that whether it's a real estate professional or a business broker or an M&A professional, it's not frequently a subject that you want to lead with or start with, because it's been historically a fact of life. Death and taxes are a fact of life, right? So we focus on the transaction, getting you the highest price and getting it closed. Those are the things that you're focused on. But if you have a solution to a burden that they're going to face that can actually help you turn that into an opportunity, maybe it's worth considering adding that at the beginning of the funnel and not kind of dealing with the aftermath of the end of the funnel or the changes in client behavior that can occur once they realize what's about to happen next. So I'm a guy that likes to use analogies in the way I communicate, so I'm going to use a baseball analogy with everybody today. So I'm going to suggest that selling a business is like baseball, right? We all know the game of baseball. Number one, as I just mentioned, sellers have inflated expectations about what their businesses are worth and how long it will take to sell. That is probably one of the earliest challenges that you face when you're evaluating the business and what its true worth is to the marketplace. I would consider that strike one. Okay, and we all know how baseball is played. There's only so many strikes. Okay, so next, once the tax reality takes hold and the clients understand that there's a pretty significant cost, it may cause those same changes in behavior I talked about. They may want to stick to an unreasonably high price because they've already got set in their mind what they're going to be able to do to fund their future lifestyle. And if they have to take less than what they have in their mind, that could cause them to change gears in ways that are not productive for you and not really productive for them. They can choose not to sell. They can postpone the sale until they can stick around a couple of years to build up the business to try to get the price that they had in their mind to begin with, or they have to make adjustments to their post-sale lifestyle expectations, none of which are positive things, right? So what if we can take those concerns and those objections off the table? That can really be helpful to you. I hope you would agree. So to illustrate, the cost of the tax burden, and let's face it, most businesses that are looking to be sold have very little, if any, basis, right? They don't have a lot of capital invested in the business. They grew it along the way, which means that virtually the entire sales price or close to it is going to be subject to the capital gains taxes. But at the end of your transaction, what's the most expensive item missing from the closing statement? It's the capital gains taxes. We've got the transaction costs, we've got the mortgage payoffs, the stuff that they do expect. But what the seller's estimated closing statement looks like does not include an estimate of their taxes. And you never know when they're going to actually discover what that looks like. And our suggestion is the earlier they know, the better off they are and the better off you are. Let's lead into a case study here, because I just want to give you an example of what's possible, because this is really more of a practical approach to how a specific business broker saved his DST deal. Now, to preface this, understand that we are pretty much exclusively working with sellers of highly appreciated assets. Could be real estate, could be businesses, could be collectibles, could be highly concentrated stock. There's a myriad of things that can appreciate in value, and capital gains is on the table. And our reason for existing is to help people defer those capital gains taxes so they have more capital to deploy, invest, to generate more income or faster growth, or both, right? In this case, with this particular example, we are dealing with a business broker who was dealing on the buy side and pulling together a creative use of our strategy to help close a deal. So let's start from left to right really quick. Start with the problem. The problem was there was a deal at risk of failing after months of negotiation, not including the prep time to get that business ready for sale, but it was going back and forth, and pretty much they were ready to fold up the briefcase and walk away. So, the broker that we're talking about was representing a buyer in Ohio and having a hard time bringing the seller down in price, unrealistic, sales price expectations. So as it's about to fall apart, he reached out to us and kind of gave us the synopsis of what was happening. And, we both agreed that look, if we focus on the most important end product of the deal, it's not what the price is that you sell it for at the top level, it's what the seller can walk away with, right? And so we got into a discussion about the terms and how far apart they were, and the buyer wasn't really willing to come up to the seller's price expectations, and the seller wasn't willing to come down. So together we did an analysis with that broker, and we started, and I'm just going to give you some inside scoop on how we would do this. So we started with an analysis based on the seller getting his top line price, and then we did a tax analysis to figure out what would he walk away with. So we knew what the bottom line was, and that the broker could use in his negotiations. And then we went through a myriad of other analysis, working with the broker to kind of say, where are you guys hoping to get? What's the best and worst case scenario here? And so we did a series of analysis with them to say, look, if we can demonstrate to the seller that he could walk away with at least as much as if he got his top line price, and the buyer that he might be able to get the seller to move off of that price and give the buyer what he needed to the point where he felt he could be successful moving that business forward, then maybe you could bridge the gap, right? That was the whole part of the analysis. Well, the result of that was we helped the broker solve the problem. The result of that was the seller was able to save and defer $385,000 in taxes, which is what he would have owed had he not had the access to, this type of particular planning. So, in the process, our tax attorney, ironed out the details, worked with the transaction attorney, created the opportunity for the proceeds to come out of the deal on a tax deferred basis, so that the client was not subject to tax in the year of sale. And so ultimately the result was, number one, the deal closed when it was basically everybody was walking away before the broker took the initiative here. They were walking away. It was done. They're going to have to start from scratch. The deal closed successfully, and they utilized the DST approach. The seller got a win because he got more money net than he would have gotten had he stuck to his high price, which he was not going to get, right? Because the market just wasn't willing to pay that.
Yeah.
By partnering with RePoint, the broker earned his commission, didn't have to start over, And he also earned a $3,000 referral fee by partnering with us. So that's just a single case study analysis, which was somewhat unique because he came across it. He was representing the buyer. We don't represent buyers, but he took our analysis and the information that we shared with him, and we let him know that we would be available to, participate in any conversations if he felt he needed us. Pretty shrewd guy. He didn't really need us after that. He had everything he needed. He first went to the broker on the sell side, presented an idea on how to close the gap between the two parties. Together, they took it to the seller. They showed the analysis, and the seller was thrilled. The buyer was thrilled. Both brokers were thrilled, and our broker created another really meaningful relationship with the broker on the other side, because let's face it, you guys are probably dealing with a lot of the same brokers on different transactions being on one side or the other, right? So he created an ally that showed that he was operating in good faith, that he was bringing solutions to the table that the other broker had no understanding or clue about that existed at the time. And so, I would say that's a win-win-win-win proposition for everybody. Now, if we take a quick step back, we take a look at a high level at your industry. So, for example, we're looking at in 2023, there were over 10,000 businesses sold, and of that, the IRS collected more than $15 billion in capital gains taxes. Considering that most sellers are looking to convert their sales proceeds into investments that will generate income for the rest of their lives, the fact that $15 billion in capital gains taxes were paid on these business sales resulted in at least $90 million less annual income collectively for those sellers. Now, imagine if you could offer a tax deferral solution that increases your clients' post-sale proceeds and also, therefore, the amount of income that they can rely on to fund their lifestyle needs that they've already created in their brain before you even get to the finish line. They kind of know what they want to do. And imagine that the strategy is something that's legal, proven, and IRS tested over nearly 30 years. Okay, this is not a gamble. This is not something that is it's not new at all. It's just new to a lot of people because of the specialized nature of what we do. So just to give you a little background on track record and history, kind of keep this short, but when you're in a situation with any business sale, and let me preface by saying that for our particular strategy, the Deferred Sales Trust strategy, to be effective and economically viable for any seller, they should be staring at least $400,000 to $450,000 or more in taxable sales proceeds. Taxable, not the tax itself, but the taxable amount. That might equivalent or equal roughly $130,000 or more in actual taxes that they would have to pay. If that's the scenario, this is something that they should probably consider, and then you may wish to consider bringing it forward to them as an option to enhance the services that you're bringing to the table. Because the way this is always positioned is you're the quarterback, you're the lead, you're trying to be a problem solver and provide the best possible outcome to your client, which now can include getting the highest price that you can possibly get from the market and increasing the seller's sales proceeds by 25 to 35% more than if they didn't have this kind of planning available to them as an option. It doesn't have to be bundled. They don't have to do it. But if you can bring it forward, I think that you're going to enhance your stature and your credibility quite a bit. So here's kind of a short list of sort of the track record. So DST's been around for almost 30 years. We've completed nearly 4,000 transactions plus, totaling more than $200 billion in closed transactions. Along the way, there's been only 16 field audits, which is great because it's a low audit risk. It was a low audit risk before. It's even lower audit risk now. The IRS has conducted at least 3 direct reviews, starting with, a week-long visit with our tax attorneys, evaluating 10 years worth of transaction records to see if they found anything that they didn't like. We have a perfect track record with the IRS. They know exactly what we do, and we've been doing it for nearly 3 decades. We've taken it a step farther to seek out peer review for some of the top tax law firms in the nation to do peer review with us to evaluate from the private sector side, did they feel that this is it legal, proven, and sufficiently IRS tested? And to affirm, they've all agreed that it was, and they would even recommend it to their own clients that had a similar need, because this is not a strategy that they themselves were doing or knew how to do, or if they decided to embark on that, it's going to take them a dozen years to really get the requisite scrutiny from the IRS that we've already gone through. So it's pretty well settled at this point. We've also had FINRA review. FINRA is the quasi-government private sector agency that oversees and supervises every licensed investment advisor in the country. Now, given that most people that come into a windfall or a lump sum of money may be great at their business, but they may not be as savvy at how to invest their money and not lose it and provide for income and growth, et cetera. And so investment advisors are usually brought into the mix regardless of planning or no planning. In our environment, a licensed, seasoned investment advisor is part of the fiduciary team that we bring to the table in every single case. And so FINRA had to do a deep dive similar to the IRS to ensure that the DST strategy was a legal, proven, and IRS approved strategy, or they would not allow any licensees under their supervision to participate. But as it stands, they have given us a clean slate as well. And then finally, there is a private letter ruling from one of our clients. That's something that most of your CPA colleagues are going to understand a little bit more. They're very rare, they're hard to get, and they cost a lot of money because the taxpayer has to seek an IRS private letter ruling on a transaction they already completed. So it's like advertising to the IRS, I just did this. Tell me if I did it right. And they're not waiting for an audit. They're basically inviting the IRS to say, you're good or you're not good. And it's rare to get those because most people will only do that if they're committing their proceeds, their resources to something that's maybe going to be long-term or locked up, and they don't want to get hit in the middle with an IRS judgment of some sort. So, sometimes they want to proactively say, hey, if I'm going to have any pain, let's just get it over with now before I commit the money to something else. So private letter ruling on the books is very positive as well. So just a little history and track record on what we've done. Now, I want to kind of give you a comparison, a little bit of an overview of how the DST actually functions and compare it to a 401k plan. So imagine that your seller can sell their business, their real estate, whatever it is that would otherwise be subject to a capital gains event. And imagine that the trust that's created and the work that goes into deferring the taxes in the first place is like having all the proceeds of sale before tax go into their personal self-directed 401k plan. So some of the comparisons between the two are this. Number one, the seller has to approve any reallocation or reinvestment of their sales proceeds, and there's no restrictions or limitations on what the trust can invest into, which means it could go into marketable securities and everything in the financial world. Proceeds could also be reinvested back into active real estate or to buy, build, or start a new business, do hard money lending, even throw some money into cryptocurrency. There's really no restriction on what the trust can invest into. Next, the seller determines the timing and the amount of any payments they wish to receive. Much like a 401k plan, if you don't need any of your money, it stays in your 401k plan, invested, working directly for your benefit until such time as you need to start drawing some money out. Same thing here. Whatever you need is only what you're taxed on. If you don't need any money right away, then you're not taxed on anything until you start to draw. And then again, only taxed on what you choose to receive. which leads us to number 3 across the chart here. They only have to recognize and pay taxes on what they choose to receive. So I don't care if the investments of the sales proceeds are generating, let's say, $100,000, just for example, in taxable events or growth. If all the seller really needs to support their lifestyle in the next chapter is, say, $50,000, then they'll only pay taxes on the $50,000 that they actually receive. The trust will not pay taxes on the other $50,000 of dividends, interest, capital gains, or growth that's occurring inside, because it's just like money sitting in your 401k plan. Until you take it out, there is no tax obligation to consider. Okay. Number 4, legacy and estate planning considerations. This is the client's money. They can have it anytime they want, but let's assume that they don't withdraw all their money plus the earnings that it can generate over time, and they pass away. This becomes an asset of their estate. They can leave it to their heirs, and their heirs will have the same rights and privileges that they do. Modify the amount of payments that are received over time, because it's not locked in stone. Modify the investment strategy, because maybe the heirs are more or less conservative or aggressive than they were. So that's on the table. And they can choose to keep the trust going through generations if they choose to. It doesn't have a hard stop date. The trust only ends when the client or their heirs want it to end. So that provides a lot of flexibility moving forward. 5th comparison to this 401k analogy is asset protection. Asset protection comes as a byproduct of what we do. So similar to the fact that if you get sued and a judgment against you in the future, your creditor, generally speaking, does not have access to your 401k plan. That's pretty much off the table. It's asset protected based on the ERISA laws that created 401ks. The DST similarly has virtually the same asset protection that your 401k plan has. So if you get sued and a judgment arises in the future, your creditor cannot go after the principal in your DST. So huge benefits. That's just kind of my straightforward comparison so people can have an understanding. And oftentimes when we're talking to clients, we'll use this analogy to help them understand and relate it back to something that they have some knowledge about. Okay. Now I want to shift back into some additional, successful business sales closed with the DST. I just want to give you some perspective of a few things. There's many more than this, but let's, and we're going to use some names. Larry Swanson, he's a Trans World broker. He was represented as seller in a $1.1 million blinds business in Illinois. By partnering with us, he was able to help their sellers defer $260,000 in taxes in the year of sale. And more importantly, his initiative helped get the deal closed and all the other benefits that may accrue to that. Matt Manavi below him, representing a service business in California, $1.2 million sale. That client deferred over $300,000 in taxes. Think about that for a second, because that may be kind of a middle sales volume for a lot of you. What could you do? What could your seller do if he had an extra $300,000 because he didn't have to pay taxes in the year of sale? What could that earn him? That's going to be $15,000 to $20,000, roughly more income, if that's what his focus was, per year, every year, 10 years, up $200,000 more that he gets to use to fund his lifestyle, to, spoil his children, et cetera, whatever they want to do. Gene Townley, TNT, $6 million restaurant chain in Alabama. By partnering with us, his client deferred almost $2 million in taxes. Imagine what you could earn on an extra $2 million that you probably weren't expecting. Is that a win for them? Absolutely. Is it a win for you? Yes, it is. How about Ron Buck Murphy? Ron Buck, helped on the buy side, a $1.2 million fitness sale in Ohio. He used our strategy creatively to help analyze and provide some ammunition, if you will, So he could take that to the selling agent, and together they took it to the seller, and they were able to close the deal that was dead. It was DOA at that point in time. They revived it, closed it. Ron earned his commission. Ron got a referral fee from us for putting it together, and everybody was happy. So, I think the best of all worlds, I think, in any brokerage business is when everybody has a win. And, I think that with our help and our strategy, we can help you achieve the same types of results. So with that, just a quick, how do you implement this? We have really a very simple process. It's very easy to incorporate into your listing appointments. If you want to be able to take that tax problem off the table right out of the gate, provide their seller with an option to have greater walk away money, 25 to 35% greater than if they had to pay taxes in the year of sale. It's a great way to beat out the competition, if you will, to elevate your service, elevate your stature, become known for somebody who delivers greater results than the next guy, and generate more referrals as a result of it, and repeat business, for the serial entrepreneurs that you represent. We have lots of tools from a marketing standpoint we can help with, whether it's email funnels, whether it's social media, whether it's flyers, or maybe it's designing something for a pitch book. We have a lot of stuff like that, but we do have one of the core tools that we have is an explainer video on our website that really can open up the conversation with your client. You can share a 2.5-minute video with them. And then if the client's interested and intrigued, then we can have a joint call together, you, your client, and us, to kind of walk through their particular transaction and what the DST might be able to do for them. And that could just kind of set the stage. You can request a review like Ron did with us to try to get some ammunition to see if he could close the gap and close the deal that was about to fail, or just bring us right to a conversation with your client. Keep in mind that the way we like to operate is that we never like to be somebody that you refer out to and hope for the best. We like to be presented as part of your team. You are the quarterback. You should be the quarterback. We want all the benefits that come out of this and all the recognition really to accrue to you. So to the extent that you make the introductions and you're part of the conversations, so that the client clearly sees that you're the problem solver, not us. We're just a part of your team in the background that you bring forward when you need us to help your client. And so it's really more of a collaborative, team-oriented approach, so that you're constantly informed every step of the way, because we want you involved, and that's really the bottom line. So we can give you more help, more information about marketing, collateral materials, education for your offices, or refreshers. There's all kinds of things that we offer. So if this is of interest, we would encourage you to maybe reach out to us. So really, that's sort of the conclusion of the presentation. I think I've kept it to just about 30 minutes at this point in time. Paul, is there any chat or questions that have come up?
Yeah, so a few questions. Warren, as I mentioned, will be reaching out to you, and there will be, just so everyone knows, a copy of this presentation sent out via email, and also reach out to us if you have any questions. And then Jen asks, tax-wise, is this similar to a 1035 exchange, essentially pushing the ball down the road? So feel free to answer, Greg, or I can chime in. Totally up to you.
Well, 1035 exchange is related to insurance. 1031 exchange is related to real estate. So in a 1031 exchange, you have to exchange real estate, investment real estate for investment real estate. It's your only option. With the DST, you can reallocate your proceeds into any investment classes that you want. So that's a huge difference. You can diversify, be more liquid. You can go back into the same asset class, or you can go into a much broader diversification. A 1035 exchange is really exchanging an insurance policy, one insurance policy or contract, could be an annuity, could be an insurance policy, life insurance, for another one, because both of those contracts have tax deferred buildup. So conceptually it's similar because you don't want to like cash out your life insurance or annuity, pay the taxes because you cashed it out, and then go buy another similar product.
Yeah.
1035 allows you to exchange from one insurance related contract to another and defer the taxes. So, hopefully that's the answer you're looking for.
That's it. Yeah, Jen, just think about it as flexibility, right? As Greg mentioned, you have a lot more flexibility in the DST than even the 1035 exchange, but it is, as you said, kicking the can down the road. So that's all the questions we have for now, and we will be sending out a recording. If anyone has any questions, feel free to put it in the chat. If not, we can be reached. Contact information is right here on the screen. But other than that, Greg, any final thoughts?
Well, I would just, again, thank you for joining us. We kind of have made it a priority to really reach out to, partner with, help educate, help support business brokers and M&A professionals. It's really a core audience for us and a core market because, sellers of businesses have so few options when it comes time to the tax burden at the time they want to sell. They really don't have a lot of good options. The DST is probably the best of a very small subset of things that are available. And so we would encourage you to, reach out to us for more information or even consult with us before you present it to a client to say, here's the deal, here's the terms, here's what we think is going to happen in terms of price and all this kind of stuff. How would the DST look? You may want to vet it before you actually bring it forward, and that's fine. We do that all day long, every day as well. So I would just, and then we can talk about any other strategy that might be on the table, whether it's charitable trust planning, opportunity zones, for people that have real estate, in addition to the business, 1031 exchanges. What are the pros and cons? What are the differences? How do we do it? So we can talk intelligently about anything else under the sun and give you the pros and cons of each option. Again, very narrow range. And then you guide it from there. You determine whether to bring us forward or not as part of your team. But just having this tool, I think is going to elevate your game. And again, just thank you for watching. And for those that did register and sign up, we will send you an email within the next week with a copy of the presentation and the video here that we've done. So you can review it at your leisure, share it with other members of your team that you may wish, or if you'd like an individual presentation or conversation with us, just let us know. All right? Cool. So thanks again. Appreciate your time. Hope to talk to you soon.
Thanks, guys.